morning, everyone, and welcome to today's presentation on working abroad in collaboration with SAIL International. I myself am from SAIL. My name is Kutso, and I work as the Global Tax Specialist within the SAIL tax team. Now, before we get started, just a couple of administrative issues. Please note that today's webinar is based on generic tax legislation. Tax tends to be a very complex part of the law and it does change quite frequently. So it is your responsibility, please, to consult with a trusted tax advisor to confirm the consequences that are associated with anything that you do. Today's webinar is created to just provide you a guideline on when you do find your trusted tax advisor, what sort of questions to ask, what to look out for, and what to note as something to consult on. More than welcome to drop your questions in the chat section as and when we go along. I will have a Q&A section at the end of the webinar for anyone who has any specific questions. Alternatively, you're more than welcome to reach out if there's anything specific that you'd like to ask about. All right. Today's burning question: can SARS tax me on my employment even though I'm not in South Africa? With the 2024-25 tax season in full swing, we thought it might be beneficial to host this webinar in collaboration with HR Talk to answer this specific question. The short answer: yes, they can. But there is a very long and complex answer, which at least I can hope to guide you on as and when we go through the webinar. But it's essentially based on your circumstances, certain conditions, and whether you meet certain criteria to be considered taxable in South Africa on that employment income that you are earning. So what we intend to cover today: SARS's tax reach. How far can SARS go to tax you on income even if you're not in the country? The difference between source taxation as well as resident tax obligations, double tax agreements, how do those work and how do those help, if at all? And if you are a South African employer, what are your obligations and requirements? What do you need to look out for? What do you need to care for? Now, the last one is digital nomads, but what you will notice throughout the presentation, there is a touch of digital nomads in each and every aspect, just because remote working is sort of what we do these days. So it does feed into all the aspects that we're going to be discussing as and when we go along. All right. So there are 4 types of employees in South Africa. Each of these employees have different taxing obligations. So for instance, there's the individual who is working physically in South Africa for a South African company. Then there is the individual working outside of South Africa, still for a South African company. Then there's the individual who's working outside South Africa for a foreign company. And then lastly, the individual who's working in South Africa, but for a foreign country. Now, all of these have a possibility of taxation in South Africa, depending on the specific circumstances around this individual. So you'll notice that the starting point is that we always look for where the individual is and the status of the individual before we look at where the income is, quote unquote, coming from. As mentioned, I don't know if you guys can see the screenshots there, but I'll read them out for you guys. Taxing rights depend on certain conditions. In terms of the Income Tax Act in South Africa, there is a separation between resident taxation and non-resident taxation. So, for instance, if you are resident, you will be considered taxable on your worldwide income and worldwide assets. This includes foreign employment income, regardless of whether you are sitting in South Africa or if you are sitting out of South Africa. So if we were to go back to the previous slide just for a brief moment, if you are tax resident in South Africa and you are an individual working in South Africa, you'll be considered taxable. An individual working outside South Africa for a South African company, still taxable. An individual working outside South Africa for a foreign company, still taxable. And if you are tax resident and you are in South Africa and working for a foreign company, you are still taxable. Sorry, I don't know if you guys can hear me. Just give me a thumbs up if you guys can hear me. I think Lungile's just mentioned that he or she is having a bit of trouble hearing me. Can you hear me now? Just give me a thumbs up if you can hear me. I'm not too sure. I'll give you a brief moment and I'll just
Tutor, I
talk
can
for a
hear
bit.
you perfectly clear from my side.
Oh, okay. Okay, I'm gonna continue. I think maybe just double check your volume and then you'll just let me know if you can hear me as and when we go along. All right. So that's based on tax residency. Now, there is a secondary tax type or secondary tax condition, and it's called source. Now, there's a whole lot of case law around it, but essentially, if you are not tax resident in South Africa, then you will only be taxable on income that is considered sourced from within the Republic. Now, the term source is not a defined term in terms of any legislation, so we've relied on a lot of case law to interpret what that word means. And over the various years, what the courts have decided is source is the originating cause of the income that you're receiving. And for employment income specifically, the originating cause is where you are physically sitting when you are earning the income, not where the employer is, not where the income is being paid into, and we'll address that a little bit later in more detail. But in addressing the first taxing condition, tax residency, we go back to the initial principles of what it means to be tax resident. If you are ordinarily resident, so you consider South Africa to be your primary home and your intention is to be physically in South Africa for an extended period of time, you'll be considered ordinarily resident and therefore tax resident. For those who don't consider South Africa as their primary home, we will look at what we call the physical presence test, which focuses on whether you are physically sitting in South Africa for 91 days over a period of 5 years. So it's 91 days each tax year over that period. So it's a days test. And then lastly, if you are exclusively tax resident in accordance with the double tax agreement, then you would have served what is called the tiebreaker test in terms of the double tax agreement. Those are the three tax residency tests that we use in South Africa, and those three determine what reason you have for being tax resident. It also determines what reason you have for breaking tax residency. Remember, it's a step approach. So they'll always look at intention first, then your physical presence, and then whether the double tax agreement applies in any if you apply. Now, if we go back and we look at those three types of employments, if you are taxable on worldwide income, so we're going back to tax residents. The tax resident, then in terms of those four categories that we mentioned in the beginning, then SARS can tax you on the employment income. Regardless of whether this is earned inside or outside South Africa, you do have tax obligations to report that income. If you are tax non-resident, that means that only the income that you are earning from a source within the Republic will be considered tax. Remember what we spoke about briefly when we mentioned source, originating causes where you physically are. So that individual that's working in South Africa for a South African company, sourced within the country and therefore taxable. And that other individual who's physically in South Africa but working for a foreign company, still taxable. This is where a lot of tax requirements and tax obligations come in. So things like registering for provisional tax in South Africa if you are not part of the PAYE or payroll system, and changing tax codes if you are seconded employee. So that means that you only have for a specific amount of time, which we'll also touch on as and when we go along. The second condition of taxation is source. Like I mentioned earlier, it does not matter where the employer is or where your salary is paid into, which bank account, whether a South African bank account or not. What matters is where you are sitting when you actually render the services that are required to earn that income. So it's two main principles. What is the originating cause and what is that location? And then that location will determine source. We only use this principle if you are not tax resident. So if we go back to those principles, focusing only on the individuals that are not tax resident, if you are an individual working in South Africa for a South African company, but you are not tax resident, then you still have a South African tax obligation because the originating cause and the location is in South Africa. If you are outside of South Africa, non-tax resident, and if you are outside South Africa, non-tax resident for a South African company versus a foreign company, not taxable. The location and the originating cause is outside South Africa. Lastly, if you are tax non-resident and you are an individual in South Africa working for a foreign company, taxable. Then we go back to those initial rules of whether you are provisional versus non-provisional taxpayer. Right. Now, double tax agreements. So a lot of the times double tax agreements serve as exemptions to tax. And what they do is they regulate who has taxing rights in order to avoid and or eliminate double taxation. So in a situation where hypothetically you are sitting in the UK working for a South African company and you've got UK tax obligations because you've triggered whatever tests and requirements that require you to pay tax in the UK, but you are still South African tax resident because you haven't gone through the formal process of ceasing tax residency. So now you've got one employment income that is being taxed by two countries. Then what we do is that we look at the double tax agreement to eliminate the ambit of double taxation. What does it say you can be taxed? The first thing it will always say is that you are taxable in the country where you are resident. So let's say in this instance, the UK. Unless you are physically rendering those services in another country. And if you are rendering those services in another country, there is a 3-test step that we look at to see whether the double tax agreement will exempt that income in that other country, or if you will still have tax obligations in that other country. The 3 steps is, are you in that country for a period not exceeding 183 days, about 6 months? So are you in that country for, say, 90 days? Is the employer that you are earning the income from not resident in that other country? And do they not have a permanent establishment in that other country? For clarification, permanent establishment will refer to things like an office, a branch, or anything of that sort that is in that country, but it does get a little bit more complex. Now, if you answer yes to all 3, so yes, I wasn't in South Africa for 183 days in that year, yes, my employer is not resident in South Africa, and yes, there was no permanent establishment, then we revert to only being taxed where you are considered tax resident, which would be the UK in this scenario, even if you are in South Africa for a brief time. Like I mentioned earlier, it does get a little bit complex because we do have to look at the difference between work days versus non-work days, incidental work days. So are you in South Africa for a holiday and happen to open your laptop, and then from opening your laptop, would that be considered a work day, not a work day? So it does get into a little bit more detail, but the gist of it is first we look at residency, then we look at source. And if both of them have conflicting determinations, and we look at the double tax agreement to break the tie, so it's supposed to say. There's also other aspects like foreign tax credits. If both countries tax you on that income, can you reclaim the tax from one country to pay it over to another country, which are all possible depending on your circumstances. So if we go back to that table that we spoke about, what I've done is sort of show tax non-resident, versus source, and then whether the exemptions would apply if the requirements are met. Again, just to repeat, there are 2 main tests. There's the first and second condition. So there's the primary one, which is tax residence. Then there's the secondary one, which is source. And the double tax agreement only serves to break a tie if there is taxing rights allocated to different countries based on both. So if you are an individual working physically in South Africa for a South African company, but you are tax non-resident, then you'll be taxable based on source. But you'll also be taxable in another country. Let's for purposes of example use the UK. So that means that the UK has taxing rights because you're resident in that country. South Africa has taxing rights because you're physically in South Africa when you're rendering the services. Then the question will be, where do you declare that income? That income will be exempt in South Africa if the requirements are met. But if it's for a South African company, those requirements will not be met because the company will be resident in South Africa, and there will be a permanent establishment in South Africa, which means that your next port of your next direction will be to claim that exemption from HMRC, which is in the UK, because that's where the requirements would work. The next two don't really apply because you are tax non-resident and there is no source, so it's irrelevant. And then the last one would apply if you are tax non-resident. That means you are tax resident elsewhere, but you are working physically in South Africa for a foreign company, then the exemptions would apply. If that foreign company is not resident in South Africa and doesn't have a branch in South Africa, it would be exempt from tax in South Africa with your tax payable in that other country. This will also apply to digital nomads, depending on how long they spend in the country. Remember, we don't have a 183-day rule for tax residency. We have a 90-day rule, 91-day rule over a 6-year period. So it will depend on whether the digital nomad has the intention to make South Africa their home, or alternatively has been in South Africa for a long enough period to be considered tax resident. But more likely than none, the double tax agreement will exempt them from tax in South Africa because they move around so much and they never trigger that more than 183-day test. Lastly, as an employer, what are your responsibilities? What do you do when there's talent that you'd like to acquire either from abroad or vice versa, you'd like to second or send an individual outside of South Africa? The most important thing is IRP5 tax code. When completing payroll and issuing IRP5 certificates, employers have a responsibility to accurately note the type of employee that they have so that they can either confirm the obligation to withhold PAYE or to not withhold PAYE. Now, determination of whether the individual is resident or non-resident will be on the employee themselves. They have to go to SARS, make the application, and get a notice of non-resident tax status letter. And with that letter, they will then have the ability to present it to you so you can apply the correct tax code. Now, under normal circumstances, so this is when we are looking at this first employee, this one, the individual who's working in South Africa for a South African company, then the IRP5 code to use would be the 3601. But for anyone else who is non-resident, has gone through the process and presented proof of non-residency to you, then you would be able to use either 3602 or 3652. Now, there's generally a difference between the two. So 3652 is only to be used for foreign income, excluding the income that would ordinarily be subjected to Section 10102. So that would be the foreign employment income exemption for those who intend to stay tax resident in South Africa. Whereas 3602 is for anyone who is rendering services outside of South Africa, but still wants to pay some sort of tax to South Africa, so they claim the necessary exemptions in accordance with South African tax law. Now, I understand that today's webinar was quite a mouthful, so I have run through it quite quickly. I don't know if anybody has any questions or anything they'd like to clarify, but we have reached the end of the webinar. I will go through the chat section first. If anyone has any questions, please feel free to drop them in there and I'll be happy to assist. I'll just give it a few moments, and then if anyone would like me to revisit any aspect or just to clarify any aspect, happy to help. I think everyone's okay. I will leave it on for a few more moments if you guys would like to go through anything else. But I think just to go back to the last slide a bit, for those who intend to stay tax resident in South Africa, so you have no intentions of ceasing to be tax resident, there is what we call the Section 10102 exemption. How that works is SARS will exempt up to 1.25 million rand of your foreign earned income. It has to be employment income. So you can't be an independent contractor or a sole trader. And there are specific requirements for you to meet before you can claim this exemption, i.e., you have been out of the country for 183 days, 60 of which are continuous. And secondly, there has to be some sort of employment arrangement between you and the person who's paying you. So either in the form of an I-35 certificate that's been issued, an employment contract, a pay slip, something that proves that there is an employment relationship. If you are invoicing for your services, that will not be considered for this exemption. The procedure for it is relatively simple. You submit a tax return annually. You exempt the income under the correct sections of your tax return, and you just outline that you haven't been in the country for the required amount of time. SARS will usually audit your tax return just to confirm that you've been out of the country for 183 days, 60 of which are continuous. So that's for individuals who are being seconded outside, but they earn below 1.25. It does get a bit tricky when you earn above 1.25 million because you will still have South African tax obligation depending on the difference. All right. If there are no questions or anything that you guys would like me to revisit, thank you guys so much for taking the time to join myself and Charlene on this webinar. I'll leave it on for a few more moments in case anybody does have any questions. But that brings us to the end.